Yo, one massive. And you know it's your boy RebelSide.fx at it again with an next banger for you guys. So from yard, big up to all my Jamaicans, big up to everyone who's watching me, all of my international people. I love you guys wholeheartedly. Just remember to like, comment, and subscribe. Yeah, man, and share. Go ahead. Let's start this video. So I'm basically here to talk about ranges today, right? I've always been speaking about them in my videos. Order block ranges. I've been telling you supply zones are ranges, demand zones are ranges. And when it comes to a breakup structure, it normally breaks a specific range and retests that range, creating a new range. But I've never really explained what's a range. So that's the purpose for this video today, right? So to put it short, when it is that we talk about range, we're talking about a point in the market. So from point A to point B, right? As we know, the market moves two ways, well, roughly three ways, we can say. So the market trends in three ways, moves in two ways. So the market moves up and down, right? So either the market moves long or the market moves short. Those are the two ways that the market moves. But in terms of trending, the market can trend in three ways. The market can trend up in a long position, the market can trend down in a short position, or the market can trend sideways, going up and down in a continuous motion, not breaking that range or that area. Now, those are what we would basically call ranges. If it is that the market is in an uptrend and the market keeps creating new highs and lows, right? So we know in uptrends you'd have higher highs, higher lows, in downtrends, lower highs, lower lows, in consolidations, relatively equal highs and lows, right? They're within the same zone. So they're not breaking above each other and breaking the current range. They're within that zone, within that range, right? That's how markets move. So if it is that we have a market that's moving in a downward trend and it keeps creating new lows, new highs, new lows, so lower highs, lower lows. Each time it breaks the previous structure and creates a lower high and um re each time it breaks the previous structure and creates a lower low, and it retraces to provide you with a lower high respecting the previous high, not breaking that high, it's creating a new zone, right? So each time it breaks structure, it breaks the previous zone. So the zone would be from the current high to the current low until it is that low has been broken. Once it is that that low has been broken, that high has been respected, the new high and the new low would be the new zone. And the inverse is true for buying markets, and the inverse is true for buying markets. If the market is buying, it provides you with higher highs, higher lows, right? Each time when it breaks a previous high to provide you with a new high and a new low, a new higher high, a new higher low, that new higher high and new higher low would be the new range or zone that you're working with and that you're working in, right? And then when it comes to consolidations, consolidations are somewhat different because a consolidation is basically a sideways trend. So the trend is moving sideways, you don't have a clear break-off structure. It respects those zones. Even if it tips above that zone slightly to grab liquidity, it comes right back and goes all the way down to the other side and just bounces and plays around within that zone, right? So it doesn't break the zone. Once it breaks the zone, then that's the end of the consolidation. And how do we know when it breaks a zone, right? A break and retest, or a change of character, right? That's how we know when the zone has been broken. Once it breaks structure, retests the zone, and then it starts to move on in its required direction, then we know that that range has been broken, whatever the range is. Now, let's take a look at the chart here. As you can see, I have the step indices or the step index chart out, right? And as it regards myself, if it is that you follow through on all my videos, you'd know that I always right, talk about volatility indices, to be specific, synthetic indices provided by the broker deriv, right? They're a unregulated broker in the United States, so they don't offer services in the US, unfortunately. But my concepts, right, or some my concepts can be used across the board, whether it's crypto, whether it's forex, whether it's commodities. It doesn't matter because it's literally the same market. All markets move the same way. All markets move in two directions, up and down, and they trend in three directions, right? Up, down, consolidation. So that's just the reality. So everything that I'm saying here can be used in any market. It really doesn't matter. Really, really, really doesn't matter, right? Now let's take a quick look at the chart here and see what's going on. Let's see if we can identify a range here on this chart, right? So looking at this, as we can see, price, all right, let's start from here and let's work our way. But so we see that price basically initiated a move here, right? Came up, it came down, came back up, and then it came down, right? And then right here, this would have been the demand zone that we would be looking at, right? Now, to understand the range, as I was explaining before, we have to understand where it is that the market started from, right? Where it is that we're viewing the market from, and where it is that the market is, and where it is that the market is potentially going. So as you can see, this is a slight M formation. So the market started right here from our peripheral vision. We can see that the market started in this area. And then the market came up here, right? The market came all the way up here. So from this low to this high, so from this low to this high, that would have been a range. Let me clear my screen. So let me go ahead and get my tools out. So from this low right here, from this low to this high, this would be a range. And let's mark this out. So this would be the most immediate move, basically, within the market, based on what we're seeing, right? So this would be the most immediate move within the market. And what happens? Price comes up, so price moves from the downtrend, it climaxes here, creates a higher high, higher low, and then it goes up an order block within this smaller range, right? Because this within itself would also be a range. Let me just zoom in. This within itself would also be a range on a lower time frame, right? So ranges form on all time frames. So price comes down and then price comes up. So from this low to this high, right, price retraces. So this would be a range within itself, and price came back within this range, tapped into an order block slash fair value gap area, and then it pushed. And it didn't necessarily break the range, it respected the range, slightly pushed down, and then it broke the range right here with this impulsive candle, and then came back and retest this range. So right now as it stands, this would have been the new range from this low to this high, and then this range has been broken and price continues on the lower time frame. But on the higher time frames, this overall move would be a higher time frame range, right? And what do we see here? So price moves impulsively from this point, right? So from this point, the initial point of contact, that it changed character. So it came here, stopped, it retests, change of character right here, break of this minor structure, change of character right here, and then it pushed all the way up, breaking this major structure right here, and then it continued all the way up, came down, retest the area, and then it came back down. Now, what happened? Price hasn't broken this area, right? This low that was formed hasn't been broken by price, and this is the new high that was formed by price. So as far as we can see, price is within this range, this overall move, because this is one move. This is an upward move. Price consolidates, MOT, right? Market operation theory, it consolidates, it breaks down, it's within this range and moving around within this range. It gives us a retracement to this area, to this supply zone, right? So it gives us a retracement to this order block slash supply zone right here, to this supply zone, this order block right here, and then it drops. But it hasn't broken this range from what we're seeing here. So break a structure right here, came down, retest. It hasn't broken this range. It came down, it respected this area, retraced, it came back, respected this area, so it's still within this range, right? So this is still the dominant range based on what we're seeing here. But then when it is that we move over, something happens along here. Price breaks and breaks below that range. So this range is no longer the predominant range. So this is no longer the predominant range because the range starts from the previous low to the previous high, right? And it's good to follow ranges within trending markets. Right here is where the trend breaks this range. So just take a good look. This is the climax. This is the beginning of the range, right? This is its climax here. Price comes down, it respects it several times, and then eventually it breaks it. Now that price has broken this range, this high would have been respected as the new quote unquote high of the new range, right? So price is currently within this range, this minor range here. You can see here. So this would be the start of the range, right? So this would be the start of the range. Price would come up, and then price would basically be within this range. So this is a smaller time frame range. Price would basically be within this range. It went ahead and it retested this area, right? This demand zone, and it pushed up. Now, once it pushed up impulsively, this entire area would be considered the new range, right? So it would start here at the climax where it is that price basically stopped before before it changed character, right? So price basically came here, stopped, and then this is the order block zone or the order block range. So this small range here, this would have been the order block range that initiated price to come all the way up here where it is that it started to make this formation. So this bullish move would be the range, the immediate range that we'd be looking at, right? And then we'd see where price comes up to this point, it comes down, it barely taps up, collects liquidity here, and then it comes down here. But it hasn't broken this area, right? It has not broken this range. It's still within this range based on what we can see. So it's still in this range. It came down, but then right here, from this high to this low, this is a range also. Like this is literally now a range. Now we wouldn't know what price wanted to do, right? Price could have easily come here, tapped here, and then go all the way up there. Price could have done that, but price did not do that. What did price do? Price came here, respected this area, tapped into these supplies, stopped into these demand zones. Price tapped into these demand zones and then it pushed up into this order block area, tapping into this order block slash fair value gap, and then it respected this range, right? So price respected this range. As we can see right here, price basically broke structure right here. So we're looking for the bias right now to show how these ranges work, how you can actually utilize them in your trading plan. So as we can see right here, this is the impulsive move. This is the impulsive move up. This is the overall range that we're working with. You had a push down, it respected this order block, then it pushed higher, and then it basically took the liquidity right here. But what happened? Price broke this low, literally pushed and broke this low, came back here, made a slight retest in this area, and it fell. And this is the 4 hour. You could have traded right here. Like persons could have traded this area. Let me just draw this out. Persons could have literally traded this area where price basically tapped back into this supply zone, right? So it barely tapped into the supply zone. You could have traded that, but evidently that would have been a smaller time frame move. That would not have been the overall movement, right? So you'd basically, well, depending on you, some persons would have taken the trade. That's good. You'd still make a lot of money on this, seeing that it's a 4 hour time frame, right? Some persons would have decided to wait, like your swing traders, they would have waited. Maybe intraday traders would have taken this trade and scalpers, right? But when it is that you watch the market basically came down because you really don't know what the move would have been, right? For like the intraday traders, maybe they would have taken this down to try to get it down into this zone around these areas, right? Maybe right here specifically, right? Because they would have the mindset that possibly the market wants to go up. Because as far as we can see, the market is basically pushing up, right? The market is overall in a downtrend as we can see. So there's a higher possibility for it to go down when you take the extensive market structure right into consideration. It's coming down. It came to this area and then it retests this entire fair value gap. You'd expect it to maybe tap into right here. Okay, when it is that you look on the higher time frame, that's what you get. But let's ignore the higher time frame value for right now and just focus on this small area here so that we can try to get a better understanding of what's going on. So the price comes up, it comes down, then it comes up, it breaks the structure, and then it retests this area, right? Now this would become the new range. This would be the low, this would be the high. It's still within this overall range because this range has not yet been broken. And then price basically comes and taps into this zone. When it taps into this zone, you see where price starts to break down. Could have gotten your entry there. But when price breaks down, it comes right at the bottom of the range, of the bullish range that we saw earlier, the overall range. And then it came back and retest that area, right? So it hasn't broken the range. So we're not sure what price wants to do. It could easily come back up all the way up to the top. Basically, price comes, it taps, it comes back, it taps, it respects the range, and right here, it breaks that range. So this range is no longer valid as this range has been broken. This range has been covered based on what we're seeing here. So right here has been broken. This is no longer internal um, liquidity for the range as it's been broken. So there's a possibility price may go down, but it can still come back and take out everything here because this would have been a new range that had been formed, right? So this previous range has been taken out. Now this is a new range in a downtrend. Price is evidently trending down at this point. We're going with the trend, right? So when it comes to ranges, you want to make sure that you work along with the trend. Price came here, it came down, it's still within this range. There's a possibility that price could have simply come here, tapped into this demand zone, and shot all the way up, right? That's a possibility that we're working with, that we were working with. But based on what we saw here, it did not. It came, it respected the zone, but then it came back and it respected this new zone that was formed, this supply zone that was formed. So it respected this demand area, right? Specifically right here, it respected this demand area. But then it came back and respected this zone and then pushed down, forming a new range right here. So this range was basically covered, right? This range has been covered once price came back to respect this zone, tap into this zone. Now price could have come down and basically used this area as a support zone, to basically go all the way up as well, right? But what did price do? Price came back, retested, it came back, and then it broke. Once price broke this area, once it is that price had broken that area, this zone was no longer valid. Once it is that that zone had been broken, that zone was no longer valid. So it was taken out because it was broken. And then this became the new zone because this area was still active. This area was still open. Anything could have happened here. So price can still come up to target these areas. And then as it regards right here, this is movement within the zone. But then right here, at this break, right, price created a new zone. You can say a minor zone. It broke structure right here. Where it broke structure, a new zone had been created. Let me go ahead and just mark that zone out. So remember, we're not aware of what price wants to do. So we're just following price, trying to understand where price is trying to head, trying to come up with hypotheses to see what price is trying to do, right? So price came here, respected this area, so it was now within this zone from this high to this low. It came back, tapped into the order block right here, and then it came and respected this area again. So it's still within this zone. So this is internal liquidity forming right here. And then it eventually broke this area. So once it broke this area, right, this high to this low, right, of this new zone, what happened when it broke here? This became a new zone. So we're basically watching from here, from this high, to see what price does. Price came, slightly came up, broke, and these are minor zones that are being formed here. But we're basically trying to look at the bigger picture. So this zone hasn't been taken out completely. So price came, it broke down, So we see smaller moves, right? But we're still keeping in mind that there's a lot of liquidity up here and also that there's liquidity here. So price may come back and target these moves and use these as internal forms of liquidity to basically cover the move up to this point. And then based on what we're seeing here, right, price literally took out the liquidity. It consolidated, then it broke the consolidation, and then it shot up. But then right here, price broke the range. So once we see this break of structure right here, right, the intention would be that price wants to go long. Sorry, price wants to go short. Price wants to fall, right? And that's exactly what we saw here. So it broke, it came back, retest this area, consolidated, and it fell. Came back, broke this area. So it broke this range, came back, retested, fell. It broke this range, right? So as you can see right here, it broke this range. So from the top here to the bottom here, it broke this range, came down, come back. Now it broke this range right here. It retested, but then it didn't break this area. It came here, it gave a higher low, equal highs, then it broke. Let's take a look at right here. Remember, we drew this line right at the top of this liquidity zone, right? So stops would have been here because persons would have seen that the market was falling and they would have entered here, put their stops, their stop losses above here. Some persons would have entered right here, put their stop losses above here, and then they would have been waiting for the market to fall, which it did. Some persons might have exited the market, some position traders, swing traders, might have exited the market, and then the market decided, okay, it's time to target these areas. So we have liquidity here in the form of fair value gaps, right? We have liquidity here in the form of fair value gaps. So it's time to basically devour all of these ranges. So look what happened here. Price came all the way up and it devoured these ranges. So it took them out as internal liquidity. Price came all the way up here. It respected this range. It consolidated and then it broke down, but it also respected this demand zone. So even though it respected this supply zone, we want to pay attention that it didn't break this demand zone either. So price came down, it came back, respected the supply zone, it came back, respected this demand zone. So there's a possibility that price wants to climb for the stops that are resting at the top of these ranges, right? And also within these fair value gap areas. And that's exactly what price did. So price used this demand zone, right, to climb further and climb higher. So what happened right here? This range from right here to right here was basically null and void, right? Because price literally ate this range up, as we can see right here. Price literally ate this range up, so it took this out, completely breaking the structure, and then it came here and it broke this structure as well. So just keep in mind, once price breaks a range, right, that range is no longer valid, right? And you have to be able to tell the difference between higher time frame movements and lower time frame movements, right? For example, right here. So even though this range was formed, it came down, this range was broken, right? This range was broken and a new range was formed. All of these smaller internal moves, as you can see, these are movements on a lower time frame. If it is that you were able to trade these areas, you would have made a lot of money because it's a 4-hour time frame nonetheless. But these are smaller time frame moves, and liquidity is resting above this area. So these ranges, new ranges, can always become liquidity for the market, for the bankers or for the hedge funds or the market movers. So it can always become liquidity. So you have to keep that in mind. So it all depends on how it is that you're choosing to trade at the moment. So if it is that you're just looking for a short-term trade, for example, the market comes here, you get a retracement to this point, it comes back, you get a retracement to this point, it comes and it breaks, right? Then you can go ahead and target this range. Market comes here, it retraces, comes back, right? You target this range, it breaks. Now you can target this internal range right here. It comes, it taps into the supply zone, it breaks. So you basically utilize the ranges along with your supply and your demand and your order block so that you can basically maximize these ranges and get the most out of these ranges, right? And let's look at this right here as well, because we want to understand ranges from a multiplicity of perspectives. Right here, as small as this would be considered as a consolidation, right? Okay, let's remove this. So this would be considered as a consolidation. So this within itself would also be a range. So price came in, it's moving, it's consolidating, right? Consolidating, and then the consolidation has been broken right here. So this range has been completely taken out right here, right? And then price basically created a new range. So it tapped into this demand zone from this high to this low. From this high to this low would have been a new range, and we'd wait to see what price would be doing within this range. And then what happened? Price broke the range all the way to the top, taking out this range, as internal liquidity, taking out this range as internal liquidity, and ultimately taking out this range as internal liquidity, right? So it took out all of these as internal liquidity, coming up to this point where it cleared the liquidity in this area. And let's look at the overall picture here, right? As we can see, it's a higher time frame move. So price basically came and cleared the liquidity here because this this move right here was a part of a bigger range, right? A very bigger or larger range. And then it break down, and then price decided that it would come back to cover all of this as internal liquidity within this range. So it broke this range, but then you still have liquidity laying above these points, laying above here. Price came and price devoured. Now let's go ahead and go to the lower time frames and see if we can take a look to get a more in-depth understanding of how these ranges form, right? And let's look right here as well, because we have ranges here also. So before we go to the lower time frames, let's just take a quick look at this as well. So as we were saying before, price came up impulsively, right? So this would have been the new range that was formed from this low coming all the way up to this high, right? So let's mark the high out. So this high would have been the new range. So between this low to this high would be the range. And based on what we're seeing here, price is basically moving within this range. So price is currently within this range, right? So looking at this, it hasn't broken above this area to create a new range. It hasn't broken below this area to create a new range. It's still within this range, right? Now let's take a look at this. Price comes down, it respects this order block, it comes back, it respects this zone, and then it breaks down. This would also be a range, right? So right here, from this order block coming all the way down to this order block would be a range. And this is a next way how you can really look at ranges. So from one order block to the next order block, in the sense of from the order block that initiated the change of character, right, to the next order block that initiated the market to change character, right? So wherever it is that you see the market basically changing character, so if the market is moving up and then there's a bullish order block, and then the market starts to move down, that order block would be the start of the range. And then once it is that the market switches where it is you have a bearish order block, that new order block would be the start of the new range. And then you'd look to see if price would basically respect the top of that range or the bottom of that range depending on the trend, right? Or if it is that it would break that range, what exactly it would do. So in this regard, right here, price is overall in a buying market, but as we see, it's within this buying, you can see it's within this buying trend, right? It's playing around within this trend, right? So it's playing around within this trend and playing around within this range, right? So it's range bound within this buying market, but yet on a smaller time frame, we can see that there are smaller ranges here, right? So price came down impulsively, it pushed down impulsively, and then right here it retest. So it's still within this range from this high to this low. It's still within this range. It hasn't broken the previous range. So right here it's coming from a selling position, right? If it is that it had broken this range, then it would have basically changed the range. It would have broken higher, and then it would have provided you with a higher high and a possible higher low, right? But it didn't do that. It respected the range. But right here, it came down, it retested, and it broke right here. So what happened? Price basically broke structure right here, right? So right here, it broke structure. Then it retested, and it broke structure again. So this would be the new range where we'd be waiting on to see what's going on. And then we keep in mind that liquidity would be lying above here, right? Price would possibly target these stops. You have imbalances here, fair value gaps, right? So you'd basically be waiting to see what would happen from this range. If it is that this range will be broken and taken as internal liquidity, or if it is that price would continue onward to form more downward ranges in this downtrend to cover the overall range of this uptrend, to cover the overall range of this uptrend here. And what did price do? Price basically came back and took this out right here as internal liquidity. So it took this out and it came here, took this out as internal liquidity, tapping back into this fair value gap, right? So it tapped into this range as the major move, from right here to here, coming down. It came back, tapped into this zone. So right now, this would be the new move. So from this high, from this low to this high would basically be the new range. And then we'd be waiting to see what will happen in this selling market. If it is that price would break structure right here, if it is that it breaks structure, then we'd understand that this range has been taken out, and we'd basically wait to see what happens if we get a retest. And then that's exactly what happened. It broke structure right here, and then it retests the supply zone. So look at it this way: when it comes to ranging markets, right? When it comes to ranging trends or trending markets, you want to understand how to utilize all your confluences with these. So if it is that you're looking at the market, let's say, all right, let's bring it back right here. So let's say you're watching the market from this point on, and the market actually drops, and then you see where the market actually taps into this quote unquote fair value gap, right? You'd be watching this range, right? This would have been the new range because the market would have fallen here, and then it would have test right here, right? So this would have been the overall range that you'd be watching. Once it is that you see where price breaks structure right here, once it is you see where price break structure right here, right, that would incline you to look for price to possibly make a move to cover liquidity in these zones. Some persons would have seen this retracement and would have taken this retracement. Nothing's wrong with that, right? You could have gotten a decent move on this retracement. Remember, it's a 4-hour time frame, right? But you basically want to get the most out of your trades, maximizing your trades, right? So this would have been the ideal move. Seeing price tapping into this area, some persons would have tried to trade here. Again, nothing's wrong with that, but this would not have been an ideal trade, right? But at the end of the day, you wouldn't have known that. You would have seen it tap into your zone and start to break down, and you'd have taken that trade. You still would have gotten a nice entry, and then price tapped further into your zone right here, and then you try to get in on this, and then you'd basically be riding this wave down, right? Because once it is that it took this range out, you were expecting a retracement. It's the same thing if it is that we were to come here to this order block and this supply zone, right? If it is that we came here, we'd basically be expecting the same thing. So this would be the lowest point. This would be the lowest point that took out the previous low based on what we're seeing. So this would be the lowest point that took out this low, and then this would be the retracement of that point. So the range would start here, would end here, right? And then we see price starting to break down. Now keep in mind, we don't know what price is planning to do. Price could easily come here and respect this demand zone and go up. But based on what we're seeing where price is showing clear decisions that it wants to go down in a downtrend. So we're expecting a selling market, right? But it doesn't have to abide by our rules, so it can easily buy, right? It's all hypothesis at the end of the day. It's all speculation and making sound hypothesis. So it comes down and it breaks this area. Once we see this break, what would we do? We would wait for a retracement into the fair value gap area or the order block. Once it taps into these zones, then we'd look for some breakdown. Normally, we'd go to the lower time frames to try and find an entry right here, right? But this is what we'd look for on the higher time frames. So this is exactly what happened. It broke structure. It impulsively retraced. It tapped into that zone, and then it started to fall, right? So that's how it is that you basically utilize your zones, utilize your ranges, to basically maximize your, yeah, to maximize your profit or your profits, right? But now I'm basically on a lower time frame so that we can try to get a more, precise, yeah, a more precise understanding of the market, right? So right here, this is the market that we were just looking at, where we saw price come. Let me just go ahead and bring my tool out, where we saw a price come into this zone. Now on the lower time frame, it's giving you a more detailed view, right? So right here we can see in this zone that we marked out, price moved from a downtrend, came up to this uptrend, climaxed here, then it fell here. Overall, it would have been in this range, in this overall range here. But once it came here, it would have formed a new range, higher high, higher low, and then this would have basically respected the area. So this right here, this second move tested this previous range and it respected this area. It did not break above to give you a higher low. So that would suggest to us that price is basically trying to determine what it wants to be done. A lot of persons would have entered here if they saw this because it's an M pattern, and once they see the M pattern, they'd enter for a sell. But we really don't know what price wants to do, right? Price could have easily come down and tap into this demand zone and go up, right? So it's good to just watch price at times to see exactly what's going on. Maybe if you went on the lower time frame, you could have gotten an entry on this. So it all depends on your trading style, right? But then we see price come here and price broke structure right here. In breaking structure right here, price retest tapped into this fair value gap area and then it fell, right? You would have gotten an entry somewhere off right here, coming down to this point and basically following price all the way down to this area, right? So as we can see here, once price broke this area, it basically eradicated this range, right? So this upward range from the bottom to the top, this was taken out, and then this became the new range from this top, right? Because basically character had changed from this top going down, from this top going down to roughly right here where you had this impulsive move. So these are all smaller moves internally, but this was the most impulsive move in this area. So this would have somewhat formed a new range, but then there are a lot of stops, a lot of liquidity laying above these areas. So you'd be expecting price to come back within this range, this overall range, to clear more liquidity out on the higher time frame and then fall further. So these are intermediary ranges. These are all internal liquidity. So look what happened here, right? So look what happened right here. So price came down, retest this area, it fell. If it is that you had gotten an entry anywhere off here, right, you would have basically been getting a decent amount, you'd be good, right? But then this would have been the major move. So price came back, right? The bankers, the hedge fund, the market movers, they basically targeted all of this as internal liquidity because this was the overall move. Price came here and formed this range and pushed all the way down, making these internal ranges to basically get you excited so that you can enter the market just to take you out and take all of your stops, take all of your stop losses, get all the money that you placed in the market. And there are a lot of persons who don't use stop losses, so you can imagine a lot of persons' accounts would have been blown. And it came back up into these zones, tapped into this area, and covered most of this previous of this range. So all of this became internal liquidity, right? And then when it came here, it started to break down. So it came higher high, higher low, higher high, higher low, higher high, lower low. So right here, it broke this range because this would have been the most recent range. So higher high from this high to this low. But then price broke that structure and came here. So this would be the new high. We'd want to see if price would come back and respect this zone and give us a higher low and a higher high, but it did not. It broke structure right here. Let me get this. It broke structure right here, and then it retest. So once you see the break of structure, you can expect price to respect this zone, but you don't want to force anything. You want to see clear signs that it has respected it, because it can easily grab liquidity here and continue all the way up to the top side. So what happened? It respected this area, tapped into the supply zones here, then it started to fall, right? And what happened? Price basically fell, right? And then all of these smaller ranges that you're seeing, right? Highs and lows, higher, lower lows, higher highs. All of these are internal liquidity. This move would have been the main move within this market, right? As it mitigated this area, and you'd expect price to possibly come back up to here, or even tap back into these zones further up here, possibly, right? But look what happened. Price respected that zone, and then price fell. So price respected this zone, right? It respected this range right here, as you can see. So this range was respected. It didn't break the range. It came, it respected it, and then it fell continuously all the way down, forming all of these internal ranges, but it fell nonetheless, right? So we definitely can see that here. And as it regards right here as well, let's look at this 15-minute movement here. Price came up impulsively, price came down. So this move, this move right here would have been, this is a range within itself. So this would have been the climax. So this would have been the sell. Then this would have been the high, right? Now keep in mind the type of market that we're in. It's in a downtrend. So you'd be looking for downtrends. So when it is that you see this range form, and then price comes here and it respects this demand zone and it comes up, you just be waiting to see what happens. If it is that it gives you a next break and a next retest, providing you with a higher high and a higher low. Right now you only have one higher low, so to speak. You don't have a higher high as yet, so you'd have to wait to see what happens. But look what happened. It respected this area. As you can see, it respected this area. It did not break above this area, right? And then it came back. It still didn't break this area, so there's a possibility that it wants to go high, that it's changing character, right? It came back and it respected this area. So right now we're at a standstill. We're not sure what price wants to be done, because all of this, it's happening within this range, right? So all of this, it's happening within this range from here to here, right? Price is basically playing around in this range. Let me just mark it out so that you can see it. And this is the thing about ranges. Once you understand how ranges work, believe me, it makes your trading so much easier, like way easier. So as you can see, I've marked out the range from here to this point, right? Now keep in mind, this is the overall range. We're expecting price to possibly come back up somewhere to this area, right? So that it can take out liquidity. So that's the expectation, because it's in a downtrend, but price can do whatever it wants. But you could still get a trade on this leg if it is that you wanted. It's a 15-minute time frame. So this would be a great, intraday move. So right here, price comes up, starts right here. So this would be the range, start of the range, the end of the range. It comes back, it respects this area, it clears the liquidity here in the fair value gap area. It comes back, it respects this, provides you with a double top, slight double top. It comes back and it respects this area, provides you with a double bottom, right? So you just want to see a break to see what's going on, to know what the next step is. Price comes back, it taps into this area, mitigates this range, then it falls, it taps back into this demand zone. So it taps into the supply zones here at triple top, it taps into the demand zones here at triple bottom. It still hasn't broken, it still has not broken this range here, right? That demand zone, and it still hasn't broken this small supply zone here. But we have but we have an expectation for the market to come back to clear out liquidity in these higher points, right? That's the expectation. So as of right now, we're expecting the market to go up, but we're not sure if the market will go up or if the market will continue to fall, right? So we're basically waiting, we're watching and looking to see what the next step is. But right here is the game changer. So basically, this can also be considered as a consolidation, right? So keep that in mind. So this would be a consolidation. So from here, coming up, and then it respects this zone. As you can see, it's not providing you with any higher highs, higher lows, any lower lows. It's not breaking. It's basically playing around within this range right here. So it's consolidating within this range. But look what happens. It breaks the tip of the consolidation right here, breaks the tip, and then it retests the zone right here, right, respecting this area. The fact that it broke structure right here, you could have looked for an entry right here, right, or even wait until you get a second retest, and then you would have taken an entry right here, and then it would have come up. Yes, it would have broken back down, but you could have gotten all of this for yourself basically. Let's just see something here. Or let's just put this here. It's a buy, but just so that we can see the possible amount. So this is the lowest lot size on this pair, which is 0.1. And you could have easily made $25 just from this small move. Easily, and let's just get that off. You could have easily made $25 just from that small move. So look here. And then basically price would have broken down, but it came back and it respected this zone, right? So some persons would basically have waited. Once it is they got this break, they would have waited to see if price would actually come back to this area. And that's actually a good move, right? If it didn't come back, okay, you just wait for a different move. You don't have to force the market. You don't have to try and trade everything, because realistically price came here and it came here and it gave you this move. That's a good move. If you traded this, kudos to you. Nothing's wrong with that. But a lot of persons would basically expect price to come and tap back within this demand zone. It doesn't have to. But if it is that you wanted to wait for that, you could have. And you waited, it came, it tapped. Unfortunately, we don't know what price did after that, if it is that it went up or it broke down, right? But you still could have gotten a move right here nonetheless. And well, let's take a look at this move and see what's going on. Right? Roughly $23 thereabout. So yeah, you could have. And let's say you put your stop loss down here. So you're risking roughly $8. Right? If it is that you were trading on the 15 minutes. So keep in mind, this is a 15-minute time frame. A lot of persons would have gone to the 5 minute or even the 1 minute to refine their entries. So their stop loss would have been like extremely small, or it depends. But some persons would basically keep their stop loss here. But risking roughly $8 to $23, that's a good risk reward ratio. So this was a long one, but I definitely hope that you guys got something of value from this and you understand ranges a bit more clearly. You understand the differences in trending ranges as it regards uptrends, downtrends, and consolidating ranges. Remember that with consolidations, price normally consolidates within a specific range. Once it is that it breaks that range, it normally breaks and then it retests that area to continue its direction. So if price is, let's say price is moving in an uptrend, it's consolidating. If it is that it wants to continue upward, it breaks up and then it retests the previous trending or trending zone, right, or the trending range. It retests that range and then it would basically continue upward. If it is that it wanted to change positions, it would consolidate, and then it would break down and then retest that trending range and continue downward. right? As I call it, the market operation theory. That's what I call it. I may do a video on this, so we'll see, right? But if it is that it's moving in trends, right? Upward trend, downward trend, right? You know, upward trends, long markets, you expect higher highs, higher lows. So once it is that a trend has been formed, the trend is broken when you get a higher high and a higher low formed in an upward market. In a downward market, a selling market, the trend is broken when you get a lower high followed by a lower low followed by a lower high, and it continues in that trajectory, right? And you have to be able to pinpoint internal liquidity apart from external liquidity, and be able to make some judgments, you know, when it is you should enter the market, understand the different time frame and how ranges operate on the different time frames. So there's a lot, but once it is you get on the charts and you start to look for these things and you start to practice, it will make a lot of sense to you. I'm just giving you the bit of information that I myself have gathered, right? When I was searching and hoping that someone would have basically helped me and provided me the information, you know. So I'm here to help you guys so that you don't have to go too far in your search. Anyways, rebelside.fx out. Peeps, big up on yourself. Lots of love from Jamaica.